While most retail traders were glued to price charts, the real decision was happening behind closed doors in Basel, Switzerland. The Bank for International Settlements, the BIS, often called the Central Bank of Central Banks, has officially moved Basel III's final endgame rules into full implementation. This isn't speculation or a leak. It's a binding regulatory mandate, and it takes effect when markets open on Monday. It was passed quietly, and for good reason. This rule changes everything. Under Basel III, banks are forced to fundamentally revalue how they treat gold and silver on their balance sheets. For decades, paper contracts were treated as if they were the same as real metal. Starting Monday, that fiction ends. To understand why this matters, you need to understand bank capital rules. Until now, banks could hold unallocated gold and silver, essentially paper promises, and still classify them as safe assets. The new regulation changes the net stable funding ratio, or NSFR. It makes holding unallocated paper metal costly and risky for banks. Short positions are now heavily penalized. This forces banks into a binary choice: either buy physical metal to back their exposure or exit the paper metals market entirely. The stated goal was to prevent another 2008-style crisis, but in doing so, regulators have effectively lit the fuse under precious metals. This rule is a death blow to the naked short selling that has suppressed silver prices for decades. Institutions like JP Morgan and Citi can no longer carry massive short positions without posting enormous amounts of capital. Manipulating price becomes prohibitively expensive. The cost of carry has exploded. We're already seeing signs of this. Banks have begun unwinding short positions in overnight markets to meet the Monday deadline. That buying pressure, not speculation, is what drives prices higher. This is compliance-driven demand. The most bullish element of Basel III is the reclassification of gold, and indirectly silver, as a Tier 1 asset. Previously, gold was treated as a risky asset, similar to equities. Now it is considered risk-free capital, on par with cash or government bonds. This incentivizes banks to accumulate physical metal to strengthen their balance sheets. Banks are transitioning from suppressing prices to stockpiling the asset. When banks flip from sellers to buyers, the price floor rises permanently. This also explains the liquidity vacuum we saw recently. Banks pulled sell orders because they knew this rule was coming. They didn't want to be caught short once the regulations kicked in. Market pauses weren't technical glitches. Market makers were stepping back to recalibrate systems for the new Basel III environment. The game has changed. Industrial users like Tesla and Samsung understand this shift as well. They know that once banks stop dumping paper silver, prices must rise to meet physical demand. That's why we're seeing aggressive buying in the industrial sector. Manufacturers are trying to lock in supply before banks absorb available physical inventory to satisfy capital requirements. It's a race between factories and banks, and honestly, there isn't enough silver for both. China has already been operating under these rules. The Shanghai Gold Exchange runs on a fully allocated, physical-only basis. The West is simply catching up. In effect, Basel III is an admission that the Chinese physical model beat the Western paper model. By adopting these rules, Western regulators are aligning with the East. They are acknowledging that paper derivatives are inherently dangerous, and that physical metal is the only true safe asset. So why should you care? Because while this makes the banking system more stable long-term, it weakens fiat currencies in the process. Banks will need to sell dollars and treasuries to acquire gold and silver. That creates downward pressure on the dollar. As gold and silver are repriced higher to meet Tier 1 requirements, the purchasing power of fiat currencies must fall. Gold revaluation is dollar devaluation. If you hold unallocated silver at a bank, this rule is a serious risk. Banks are now incentivized to close those accounts or cash them out, because unallocated metal has become a liability. Expect letters that say, "We're discontinuing our metals program. Here is your check." If you don't hold the physical metal, you risk being forced out at the worst possible moment. You won't hear about NSFR or Basel III on the evening news. It's too technical, too boring. But this is the plumbing of the financial system. The media will talk about volatility, not causes. The root cause is a fundamental shift in how banks are allowed to leverage paper assets. The era of infinite leverage ended last night. This is as consequential as Nixon closing the gold window in 1971. Back then, we moved away from metal. In 2026, through Basel III, we are slowly moving back toward it. A quiet, bureaucratic return to sound money disguised as banking reform. Central bankers know the debt is unsustainable. They're preparing lifeboats, and those lifeboats are made of gold and silver. With banks stepping away from manipulation due to rising costs, real price discovery can finally emerge. Short-term volatility is likely as paper shorts unwind, but the long-term trajectory is clear. Prices must rise until physical supply meets physical demand, without paper dilution. That equilibrium price is far higher than $85. Because banks must hold more capital, they will lend less. This will tighten credit across the economy. Mortgages and business loans will become harder to obtain. Deflationary pressure will be met by inflationary money printing, creating stagflation. And in stagflation, silver historically performs better than almost any other asset. The rational move is simple. Align with the banks. If banks are forced into physical metal, you should be there too. If banks are exiting paper contracts, you should exit them as well. Don't fight the rules. The wind is shifting toward tangible assets. The rules have changed. Monday marks the beginning of the Basel III era. Banks are scrambling. Shorts are covering. Physical supply is tightening. This isn't a conspiracy. It's a regulatory reset. The paper game is ending. The physical game has begun. For years, the London Bullion Market Association exploited a loophole that allowed unallocated gold to be treated as a high-quality asset. This made it possible to lease the same bar multiple times, building a massive paper pyramid. Basel III closes that loophole. To qualify as Tier 1, the asset must be allocated and physically present. That requirement is forcing LBMA clearing banks into a frantic scramble for real metal. And that scramble has only just begun. The era of fractional reserve bullion banking is coming to an end. As London is forced to demand physical delivery to meet these new ratios, the drain on global vaults will accelerate at a speed we have never witnessed before. The entire $100 trillion derivatives market depends on the perceived stability of bank collateral. By forcing banks to hold higher quality collateral, namely gold and silver, Basel III makes derivatives trading far more expensive. This sets the stage for a major deleveraging event. Hedge funds that relied on cheap leverage to short silver will be forced to exit those positions because banks will no longer lend to them at favorable rates. The resulting short-covering rally won't be driven by hype or emotion, but by the internal mechanics of the banking system itself. Sovereign wealth funds in the Middle East and Asia anticipated this shift. They understood that once gold was elevated to Tier 1 status, its price would have to rise to support global balance sheets. They have been positioning ahead of this change for nearly 2 years. Now that the rule is active, we expect public announcements of new allocations to precious metals. When a fund managing $1 trillion reallocates even 1% into silver, the impact is explosive. Although Basel III formally targets gold, silver benefits through direct association. Historically, the two metals move together. As gold regains its role as ultimate money for central banks, silver reclaims its role as monetary metal for the public. The gold-to-silver ratio will compress as investors recognize silver as the undervalued counterpart to the new Tier 1 asset. What we are witnessing is a quiet remonetization of the entire precious metals complex. Ironically, these regulations were designed to make banks safer, yet in the short term they increase systemic stress. Many banks simply do not have enough physical metal to meet the requirements. To comply, they must buy metal on the open market, pushing prices higher against their own short exposure. This creates a dangerous feedback loop where compliance itself threatens solvency. In response, the Federal Reserve may be forced to print money to facilitate these purchases, an inherently inflationary outcome. There is also a deeper conflict emerging. Basel III favors hard, physical money, while other arms of the global system push for CBDCs and digital control. One faction seeks collateral and survival. The other seeks surveillance and dominance. Commercial banks need gold to endure. Central banks want digital currencies to command. In this internal struggle, individual investors have an advantage, holding the asset both sides require: physical metal. With these rules come stricter audits. Regulators will now inspect vaults to confirm that the metal actually exists. Many banks have likely been counting leased metal as owned inventory. As audits begin this quarter, double-counting schemes will be exposed. Any institution unable to prove physical ownership will face closure or bailout. Demand for fully audited deliverable bars will surge. Miners also play a crucial role. Basel III incentivizes miners to sell directly to banks, bypassing retail channels. If a major bank needs tens of millions of ounces to meet compliance, it will source directly from the mine. That leaves little to no supply for industrial buyers or retail investors. The squeeze on retail availability will intensify as banks hoard supply for regulatory purposes. While the rule technically begins Monday, full implementation unfolds over time. But markets are forward-looking. Prices adjust to future realities long before deadlines arrive. Smart money isn't waiting. It's already positioned. By the time the full impact is visible in 2026, silver prices will likely already be well into triple digits. The rules have been passed. The age of paper manipulation is ending. Not because banks wanted it to, but because regulators forced their hand. Basel III is the catalyst that compels honesty. Honest money means higher prices for gold and silver. Banks are buying, nations are buying. The only remaining question is whether you are. History doesn't repeat, but it rhymes. In 1933, gold was confiscated to reprice it. In 1971, gold was abandoned to enable unlimited printing. In 2026, Basel III quietly remonetizes gold to stabilize the system once again. Each rule change produces a massive wealth transfer. Those holding paper assets lose purchasing power. Those holding physical metal preserve it. This regulation signals that the cycle is turning yet again. Fiat currency is being quietly acknowledged as unstable, and the system is retreating to hard assets. Why now? Well, it's because inflation is persistent. Central banks know they simply can't return inflation to 2% without, triggering economic collapse. So instead, they're kind of redefining what qualifies as safe. By elevating gold and silver to Tier 1, they're actually creating a new anchor that's capable of surviving prolonged inflation. They're preparing for, honestly, a decade of elevated prices. If banks are hedging inflation risk with metal, maybe you should too. For decades, U.S. Treasuries were considered the ultimate safe haven. But Basel III really challenges that assumption. By placing gold alongside bonds as risk-free capital, regulators are, in effect, admitting that bonds, which lose value when rates rise, are no longer sufficient on their own. This is going to drive a long-term shift of capital out of bonds and into metals. Trillions of dollars will rotate. Even just a 1% reallocation from bonds into silver would, honestly, dramatically reprice the market overnight. You've probably heard talk of a global reset. Well, this is what it actually looks like. Not a single event, but really a sequence of regulatory changes. Basel III is a cornerstone of that process. It restores gold to the center of the financial system and moves the world away from a dollar-centric order toward a more neutral, asset-backed framework. That shift benefits countries with large metal reserves, and at the same time, signals a regulatory concession from the West to the East. The document is signed, the rule is active, the banks are moving. The window to position ahead of this shift is closing rapidly. Once the full force of the banking system enters the physical market, retail investors will be priced out. Don't wait for headlines to guide you. The news, honestly, is written by those who want to acquire your assets cheaply. Watch the rules they pass. They always reveal intent. Follow the money, not the messaging. Buy what the banks are buying, not what they are selling.